Most people think inequality comes from unfairness, corruption, monopoly, connections, or exploitation. These things matter, but the uncomfortable truth is that wealth gaps can grow even when nobody's obviously cheating. Imagine 10 people on a small island, all living by fishing. At first, everyone catches 10 fish a day. Then one person builds a better tool and catches 30. He did not steal. He did not break the rules. He simply became more efficient. The real gap begins after that. With extra fish, he has surplus. With surplus, he can build a boat, explore better waters, store inventory, and hire help. Slowly, he stops being only a worker and becomes an asset owner. Others still trade labor for daily income. He uses tools, assets, and organization to create more income. That is how inequality compounds. More resources create more efficiency. More efficiency creates more surplus. More surplus creates more investment. More investment creates more advantage. Markets reward efficiency, but they do not automatically create equality. This is why modern inequality is not only about income. It is about the balance sheet. A salary grows slowly, usually 1 year at a time. Assets can compound. Property can rise. Stocks can rise. Business equity can rise. Financial assets can create more financial assets. Two people may earn similar incomes today, but if one owns assets and the other owns nothing, their lives can look completely different 10 years later. This is the hidden divide of the modern economy. Not just who earns more, but who owns more. The financial system also tends to favor people who already have assets. If you own property, you can borrow against it. If you own stocks or a business, you may access capital more easily. Assets make banks more willing to lend. But people without assets usually face the economy from the consumption side. Rent rises. Food rises. Insurance rises. Living costs rise. They feel inflation, but they do not benefit from asset inflation. That is why many people work harder and still feel further behind. They are participating in the labor market, but not in the asset market. Labor pays wages. Assets create compounding returns. These two systems move at different speeds. So the wealth gap is not simply between lazy people and hardworking people. It is between those who can turn income into assets and those who cannot. Hard work still matters. But if hard work never enters the asset system, its ceiling is limited by time. The real wealth loop is this. Income becomes assets. Assets create cash flow. Cash flow buys more assets. When more people cannot enter that loop, inequality becomes more than an economic problem. It becomes a question of whether ordinary people still believe effort can change their future.